Welcome to this Bennett Explains finance video. This week, big dividends, a good or bad idea? Now, a firm makes £100 million of profits in a year, let's say. What are its choices? Quick bit of revision before we march on. Number one, they could keep all that money to themselves. And if they do that, as an investor, you'd want a reason for it. So maybe they're funding innovation and future organic growth. Maybe they're looking to fund acquisitions, or maybe they're looking to strengthen their balance sheet, perhaps by reducing debt, building up a cash reserve, whatever it happens to be. But you need a reason why they're keeping the cash. Now, we're looking at the alternative situation, which is where a company decides to return it to shareholders. And there are two ways they can do that. I'm going to focus on the first one here. Paying big dividends and or buying back their own shares. Either route will result in cash going out of the business into the hands of shareholders. And whilst you might think, well, that's happy days, actually, let's consider which is better and are there any warning signs to look out for when companies take route 2. Now, did you know, because a lot of companies are taking route 2, that European companies are paying out the highest proportion of their earnings as dividends, it's known as a record payout ratio in the jargon, in more than 40 years. And Thomson Reuters data suggests that nearly 60% of Europe's earnings, it's a pretty big number, are currently being paid out as dividends. So have companies gone too far too fast? That's the question. Are there any risks? Now, what's being said about all these generous dividend payouts? Well, we've got a top analyst at S&P Global Market Intelligence saying we're seeing a lot of companies trapped into their dividend policy. They offer generous dividends and they feel they can't pull out. And we've also got Tim Crockford at Hermes, to name but one, saying actually we like companies that don't pay out too much of their cash flow as dividends. So what's going on? Surely big dividends are good news for shareholders. Well, they can be. And I'm certainly not suggesting in this video that dividends are bad per se, for one simple reason. Let's take a look at this chart. Now this shows what would have happened if you'd invested into the FTSE All-Share at the start of one of the worst bear markets, beginning of the early 1970s, kept your investment rolling and reinvested, that's important, reinvested all the dividends you received back into shares all the way up to the end of 2015. Now, the bottom it says the past is no guide to the future necessarily, or no guarantee, but here's the point. You would have basically made around, ignoring charges and spreads and so on, 108 times your original investment in the FTSE All-Share on a total return basis. We say that again, 108 times. So, played the right way, dividends can generate some pretty impressive returns added on top of any capital gain you make from shares. And fans would say, yeah, great. On top of that, dividends are a tangible benefit to shareholders. It's cash in your pocket. It's jam today, not waiting for jam tomorrow. They impose cash flow discipline on managers because managers have got to run the business in a way that generates the cash needed. And reinvested, they can really power up your long-term returns. So what's the problem? Well, there's a flip side to this coin, and critics are increasingly getting nervous about the high level of dividend payouts and saying, watch out. Why? Firms that pay big dividends might have run out of ideas. They're returning cash because they can't think of anything else to do with it. They can't think of any decent projects to invest in. That's not a good thing. Maybe it also breeds complacency. They think, the way I'll keep my shareholders quiet, shove them another dividend and not worry too much. And that's not good either. They might be using debt to fund these payouts, and that's even worse, gearing up to pay out dividends. And big payouts can eventually weaken balance sheets and ultimately not be sustainable. So you get jam today, but will you get the same jam tomorrow? So as an investor, what are you supposed to do? And the answer is homework. All right, two things. Well, first of all, diversify. I'll remind you about why in a moment. Do not put all your eggs in one basket. Do not pick a huge company that's been a regular, reliable income payer and go, I'll take that one. But even so, once you're spreading your risk out, get under the bonnet, see what's going on. So check the business logic. Is this a business with a model that is cash generative or not? Check earnings cover. Has it got out of control? What's the pattern over the last 5 years? Check free cash flow cover. I cover these in more detail in other videos. To what extent does free cash flow cover the annual dividend? And check debt levels and look back and see what the trend looks like it's been. All right, having done your homework, if you like, done your safety checks, then also spread your risk over companies that pass those tests. Word of warning at the end as to what can go wrong if you don't. This graph belongs to none other than BP. Biggest company in the market, most reliable dividend payer at the time, bang, deep water disaster, dividends slashed, capital expenditure cut, fines, all the rest of it. And that just goes to show that even the biggest, steadiest dividend payers can get it wrong, hence the need to diversify. A lot of ground covered there on a big debate, so feel free to email me for more information, editor@killick.com.